So I just put $5,000 in a new long-term position, and we're going to go over the company. The company is Zynga, and I have right around 700 shares at an average price of $7.48. We're going to go over why I took this long-term position, why I see value in this company, where I see them going in the next couple of years, and go over the financials. Guys, hit the like button, subscribe to this channel. Thank you for all of the support between the both channels. Like, we're up to nearly 30,000 subscribers. If you are a trader or somebody more interested in trading, you can go ahead and check out our second channel, Traders Helping Traders. This one is all about long-term investing and long-term wealth building. But the stock we're talking about today, like I said before, is Zynga. So for those of you who do not know what Zynga is, they are a company that develops and markets, operates social games as a live services played on mobile platforms such as iOS, Android, social networking sites such as Facebook. Zynga generates revenue through mobile game downloads, in-game sales of virtual goods, and advertising services. Zynga's revenue is divided between online games and advertising, where online game accounts for the vast majority of their total revenue. The firm's top 3 games account for the majority of its online gaming revenue, and the company invests in several game categories such as social casino, Zynga Poker, casual things including World with Friends, action strategy including Empire and Allies, and Invest Express including Farmville. So those are like the 3 main games that, if you've ever played them, these are owned by Zynga. But why do I see value in them? Because one of the things right now, the company is not profitable. We're going to go over that pretty soon. It is very rare that I invest in a company that's not profitable, but where we are right now in the market, I feel that there are not a lot of companies that are undervalued at this point. So I find that the company is very undervalued. It's very attractive to me, the amount of growth that this company, even on the low end, is supposed to do. Just from like an analyst standpoint, even if you take those analyst numbers and cut them in half, it is still a massive growth rate number. I don't see mobile video games going away at all within the next 5 years. If anything, I see it substantially growing. And also their financials, even though they're not profitable, do look good, that they're a very growing company. So just for a little information, some of their mobile competitors are Glue Mobile. Glue Mobile is a company I actually owned a very long time ago at like $4 per share. And then Huge Incorporated, I've never actually looked into them, but Glue Mobile is basically like their direct competitor. Now let's take a look at their financials right now. So the valuation that I've seen across the board for a lot of people for like their fair market value and what they believe the stock is set at is right around, I'll actually go over to Wall Street, Simply Wall Street, be easier for you. A lot of people have, this is the wrong one. I actually have the wrong one up. I was looking at Visa. But a lot of people have a fair value between $16 and $20. I have a fair value right now at about $14. So it's at least a 50% sale that we're getting here, which when I'm looking at my potential risk management from a long-term investing standpoint, I'm really looking to hopefully at least have a 50% sale. So this means, like, let's say the fair value is 14, I can get in at 7 so that I know the company is worth more than what it's like. I'm buying it at a deep discount, because the issue is normally I'm purchasing a stock that is already making money. This company is not. So normally, let's say that I think the book value and the fair value, if they were to liquidate everything today, is $14 a share. If I'm buying in at 7, that means that the company's already worth more than what I'm paying for it, because a lot of stocks are based off of what future growth is. But in the instance of Zynga, that's basically what we're doing here. We're looking at future growth, hoping that the president or the CEO and the executive team and everybody within this company are able to continue to push this company forward. And we're really speculating here on growth. This is definitely a speculative investment. Now let's take a look at the income statement. The biggest thing I want for an income statement is going to be growth year over year. So you can see the 3-year growth. The cool thing Morningstar does is actually give you a little graph, but the 3-year growth is very, very good. You can see here that we did about $910 million worth of revenue in 2018. 2019, we did $1.32 billion worth of revenue. You can see in 2020, another big growth year, $1.97 billion worth of revenue. Now, of course, more people are inside, more people are playing video games, of course, but then look at the trailing 12 months since the world has opened, $2.52 billion in revenue. So this growth from 2020 to 2021 is very, very good. And they have fourth quarter earnings coming up pretty soon, or third quarter earnings coming up pretty soon as well. But this is very good. This is what I'm looking for: consistent growth in the company, because that's showing that we should be able to easily grow over the next 5-10 years. Then if we look at the balance sheet, very strong, right? So right now at this point, we have $6.13 billion on the balance sheet, with the total assets being of 6.13 and total liabilities being 3.11. Now, one thing you normally want to see here is, you can see here with the assets that the assets are growing, but the debt is growing. Best case scenario, you want to see assets going up and you want to see the debt going down. That's the best case scenario. But we still have this 2-to-1 risk versus reward ratio that I like when I'm looking to invest in a company. I always want to see double the amount of assets to the amount of debt, which we are getting right there. Let's head over to Simply Wall Street here. And let's go back up to company overview, which we talked about before. So valuation, they have a fair value of 16. Like I said before, for me, I believe that the fair value is probably right around 14. If we just look at their major little check marks up here, this is what they consider a pass or a fail. So one of the failures is that shareholders have been diluted over the past year. Yes, that is the case, but from a long-term standpoint, I say this all the time on this channel and on my second channel, to me, that doesn't matter as a long-term investor. I would rather have you dilute shares a little bit to pay off some debts, raise some money so that you can go out and reinvest that company into R&D or sales, so that you can make the company better. I don't care if you're diluting shares to make the company better. However, there does become a point. To get to pass where they are forecasted to achieve profitability within the next 3 years. I do think that that's possible after looking at their potential growth and how they've been managing debt. So it does seem within 3 years, company could be profitable. And imagine if they become profitable and they're growing at the rate that they're growing at right now. It is seen that their revenue should grow 107% over the next 3 years. I do believe that as well, 107%. You could see what we were saying here before. If we go back to their income statement, the growth that they've had, they can easily double this $2.52 million within 3 years. I do think that by 2024, 2025, they will be doing about $5 billion to $6 billion in revenue per year, which would be massive for the company, obviously. Are they in a good financial position? They have cash sufficient for at least 1 year of operations. So that's what I was saying before. Even though they are not profitable, they do have a lot of cash on the balance sheet, which is extremely important for an investor like myself, especially since this is a little bit riskier. Is their dividend sustainable? They obviously don't pay a dividend. Is their share price liquid? Shares have been stable over 3 months. Do they have sufficient financial data? Yes, they do. Is there any concerning recent events? No, they don't. Do they have meaningful levels of revenue? Yes, $3 billion I would say is meaningful. They said as well. And do they have a big enough market cap that's meaningful? Yes, $8 billion market cap. So that's definitely good as far as they're considered. If we're looking at future growth here, they have it set at about 107%. Like I said, I think they can at least do 90 to 100%. I think they will definitely double over the next 3 years from a revenue standpoint, up to about $5 billion worth of revenue. And that's where they have them set right about right now. This is the industry. So the entertainment industry set to move at 32%, market set to be at 15%, and they're set to be at 107%. Future return on equity is not bad at all here. So future ROE, that's what return on equity is, looking at about 16% return on equity. If you do look at the past performance over the past 5 years, the stock is down. So if we go and we just take a look very quickly at this chart, which we are going to talk about the chart in a minute. Over the past 5 years, the stock is down, but you can see that we're still not doing too bad at this very moment. And then we're going to take very last at the financial health of the company. We've talked about this before. Obviously, no dividends, and then the management. So as of right now, I have looked into Frank, who is the CEO. Gubay, I think Gubay is how you say his name. He has been with the company for 5.5 years. He gets paid $32 million per year. Guys, what am I doing? I need to go be a CEO of Zynga. But I do think they have a really good chief executive officer. I do think that over all of their executives are very, very good. I do think overall that this company could be a huge company in the future. The biggest issue at this point is going to be the fact that I'm very worried about how much debt that the company is bringing on. That is the biggest issue that I have at this moment, is the amount of debt that the company is bringing on. The revenue is growing. That's great. But let's say revenue didn't grow and debt continued to spiral out of control, then there could be a major issue. But I'm not really worried about it. If we look at how Zynga has performed since, we'll say 2016. So let's just look at the past 5 years. You can see very volatile, right? Of course, the stock has been volatile. There are times where the stock was all the way up at $12.50. It has significantly pulled back since then. So if we look at Just back in February of this year till now, the stock's down 40%. However, one thing you'll notice is that we have been riding this trend line for a very long time. Like every single time, this bounces off this trend line. So overall, I do feel like from a fundamental standpoint, this company is a very strong company for being a spec company. I think the potential rewards are massive. My 3-year analysis is I think this stock will easily be worth somewhere around $20 to $25 within 3 years. And my 5-year analysis is somewhere between probably $35 to $40 within the next 5 years. So massive upside potential. Yes, there is a lot of risk, but this is a company that I'm really happy to be investing in, and that I'll keep you guys posted on going into the future, guys. I did take a lot of long-term positions today, so I will be keeping you posted on them. I will do some videos on them. I had some people ask me to do a video like this on Lucid Motors, so I will check that out. And I have some other videos that I'm going to have coming out within the next couple of weeks, guys. Thanks for all the support. Hit the like button, subscribe, and I'll see you guys next time. Peace.